Hello everyone, welcome to a fund review at Phenomenal. Today we are going to look at the largest multi-asset fund in India. ICICI Prudential Multi-Asset Fund has been trading since 2013, the direct version, and it has an AUM of about 52,000 crores, which is humongous, and it's charging a very high expense ratio of 0.72%. We will get into that debate of the high expense ratio in this category later in the video when we are comparing the peers of like different multi-asset class funds. Now, let's understand what's multi-asset fund. The category of multi-asset fund is basically you have multiple asset classes in the fund, and the four major asset classes are equities, bonds, currencies, and commodities. And also you have cash if you consider that as another asset class separately. And the fund manager has the ability to move around the allocations between these asset classes. So when the fund manager thinks the equity market is going to go up, so fund manager can allocate up to 60-70% to equities and maybe commodities like gold and silver. So depending on the fund manager's skill, the allocations differ from one multi-asset fund to another multi-asset fund. Now, let's understand what this fund has done historically and also compare this to a benchmark to understand is this fund manager providing you any value from providing this fund itself, right? So currently, we are just looking at Nifty 50 as a benchmark, which is exactly not the right benchmark to compare against because it's a multi asset fund, whereas Nifty 50 itself is a pure equity fund. But even if you look at just pure equity, right, it has beaten the pure equity, that is the Nifty 50 benchmark itself, right? You can see the ICICI Prudential, which is the blue line. But I think for having the right benchmark and comparing your fund against the right benchmark gives you more clarity because it's a multi-asset fund, right? So that you can compare apples to apples. So I've created a benchmark. I don't want to complicate the benchmarking process too much. You can also ask why the suggested benchmark is Nifty 100, not a multi-asset benchmark. So currently in the standard benchmark, there is no typical no multi-asset benchmark per se. So we have created a custom benchmark which is 60/40. So it's easy to create custom benchmarks here once you go into the dashboard where you can create your own portfolios, right? So custom benchmark primarily has um, two components, right? One is equities, which is the Nifty 50, 60%, and another one is the bond, like long-term bonds, 40%, right? So this is, you can consider this as like an ideal or like a basic benchmark, like a multi-asset benchmark because it has multiple asset classes, right? Mainly equities and bonds. So even if you take this as a benchmark, right, it has performed, it has fared well compared to the 60/40 as well as the suggested benchmark, which is the Nifty 100. And if you look at the outperformance itself, right, it's on the higher end, right? It's definitely, it has done well. One important thing to note here is that the 60/40 benchmark has a very low volatility compared to the multi-asset fund itself. And this low volatility comes primarily from higher allocation to bonds itself, that is, which is the 40% allocation, right? Whereas a lot of funds, including ICICI Prudential, has about 15 or even less than that in the bonds allocation. So one needs to understand that this fund has a higher allocation to equities. I will also show you the asset class exposure in the coming when we are comparing the peers. Um, Now, so to let's go into the return based factor exposure analysis to see where the exposures are coming from. Since we are now already having 60/40 benchmark, And also we also have like a bond factor here. I will quickly change this to Nifty 50 so that the 60/40 benchmark already has bonds in it. So this might not be the right way to show the factor exposure analysis, right? So we are basically replacing the benchmark with Nifty 50 so that no, we are just stripping away the bond component so that we can see exactly where the exposures are coming from, right? So now you can see that the Nifty 50 exposure itself has been like it's not exactly close to one, but it's been diluted, right? So you are getting like the current beta is around 0.4, 0.6, right? And although the fund has higher allocation to equities, about 60-70%, right, it has managed to keep the beta lower. And one possible reason is like it has a lot of low volatility exposure as well. So fund manager has managed to outperform the market, which is the Nifty 50, by somehow the manager skill plays a big role here as well, right? The beta has been low. At the same time, you also are outperforming the market with a very low volatility as well. So even if you compare the volatility of this fund with the Nifty 50 itself, right, it's much lower with the higher Kager. So hence you have a higher Sharpe ratio as well. Now, let's go into alpha attribution to see whether the fund manager has generated alpha. This is not a core equity product. So when you are replacing or looking into like a core equity product, alpha plays a big role. Since it's a multi-asset, it might not play a big role when you're looking into the multi-asset because it has multiple asset classes of its own. But still, just as an exercise to see whether the fund manager, how the fund manager has done, we will look at the alpha analysis as well. Again, I think we have Nifty 50 as benchmark. Even with Nifty 50, which is pure equity, it has produced alpha all years, right? Right from its inception till now, till last year, it has generated alpha, which is impressive for a multi-asset fund, which is not pure equity, right? You expect this kind of alpha consistency, even for specific or even for like pure equity funds. You don't see alpha consistency like this, and probably this is the only fund till now that I've seen which has produced alpha in all the years compared to Nifty 50. But again, we have to compare it with a proper benchmark. So we again revert back to 60/40 benchmark here. So as you can see, it has already outperformed or produced alpha with pure equity. So there's no surprise that it's again showing 9 on 9 years that it has generated alpha throughout its inception of the fund, right? So you can see that it's all, if you see the blue lines, right? In 2017, you can see 8.9% of the returns are unexplained, which is impressive, and it has consistently it has done, which is again we have to give credit to the fund manager as well. And you can finally see the consistency of alpha, the cumulative consistency of alpha on a monthly basis. And there's no surprise again, the fund manager cumulatively has done well here. Now, going to the peer comparisons. So, how this fund has done compared to its peers. So, I have selected 4 peers with kind of similar equity asset class exposure, and also with the 10-year of history, with at least 10-year of history, so that it's easier to compare these funds against, because the longer the history, the more data points you have to compare against, the more analysis you can do. So, ICICI Prudential is currently it is the best multi-asset fund compared to any other multi-asset. The close competitors are Kotak. It has again done well. There's been times where Kotak also outperformed during COVID, not during COVID exactly, but during 2020 it has done well. There's also third competitor, which is the Quant multi asset class fund, right? One important thing to notice or to show here is the high drawdown of this ICICI multi-asset class fund. So compared to its peers, I'm saying it has the highest drawdown, especially during COVID, right? Not exactly, it is not the highest. So you have both ICICI and Quant multi-cap as these lowest drawdown. That is the highest loss in terms of like drawdown itself, right? The second one is like HDFC that's protected, but these the lower drawdown ones are the ones which has lower equity exposures, might have had lower equity exposures at that time. Now going into the fundamentals of this fund, right? So almost all the funds have about 70% of equity exposure, except the quant multi-cap, which has only 50% currently, right? 50% in equities and 42%. But overall, the ICICI Prudential has about 70% in equities, 14% in bonds, and cash and commodities, gold, silver, and all. It comes under others. So you have 19, that is about 20% in this category as well. When you go into the core factor exposure analysis, this is also a bit interesting. So in the last 12.5 years, when you do a regression analysis, the highest among all multi-asset class peers, this has the highest beta, which again tells you how exposed this fund is to equities. And maybe one of the reasons why it's doing well is the high exposure to the equity factor. There is Nifty 50 as a whole, right? It has higher market exposure. If you compare that to, let's say, Quant multi-cap, right, multi-asset fund, it has very low exposure because of, again, it has like lower allocation to the equities, like the whole equities itself, right? Finally, coming to the fees part of it, right, which I promised to discuss. In terms of fees, it is on the higher end. So you have 0.72 ICICI Prudential versus again HDFC is charging 0.8 percent. At least for ICICI, you can say that it is doing well. So it's charging on the higher end. For HDFC, I think the CAGR is around 12% compared to this is like 17% in CAGR, right? So, but also it depends on what you're looking, right? So since these are both HDFC and ICICI, they're all close in terms of equity exposure as well. You might ask like, okay, why should one pay HDFC, right? So there's something on like the fees part of it, right? It is still on the higher end, but you can justify it with the performance they have been doing well and also outperformed and fared well compared to its peers. Finally, I will quickly show you how this fund can be replicated. But again, this is going forward. Sorry, going backward, right? Historically, you can replicate this. This might not happen going forward, right? So I quickly replicated, created a portfolio of like small cap, mid cap, large cap, and allocated like 25 like total like 75% in equities, 15% to bonds, and 10% to gold. Let's see how this fund has done compared to the ICICI Prudential multi-asset fund. And there you go. So we have been able to replicate the fund and when at times outperform here, over here and all 2021, the ICICI Prudential. So this is like a simple replication exercise to understand what's in the portfolio itself and how the fund manager is allocated between different asset classes, right? This is going like seeing historically, right? If you are looking into replicating this portfolio, this is one way to replicate the fund itself. I think that sums up. We are coming to the end of the video. What we have looked at is this fund, multi-asset fund, which has multiple asset classes. It has done well in terms of alpha, in terms of outperformance since its inception, even when you compare it to a pure equity product, as well as like a 60/40 benchmark, it has generated alpha throughout its history, right? Again, you have to give credit to the fund manager itself. And when you compare it to the peers, again, you are seeing the same picture, right? It has done really well and compared to its peers as well. And the fees is on the higher end, but you can justify it with the performance, right? That's the highest figure in the multi-asset category. And that too, it's outperforming even the simple index Nifty 50 products as well. And one thing to understand is this is like going backwards, right? Historically, it has done well. So you might question, or one might question that going forward, this might not. But no, the analysis is all backwards, right? So thanks a lot for watching. See you next time.